in Rohit Srivastava, founder and strategist at Indiacharts.com. Rohit, good to have you with us here, but we've seen markets puke it out all out. I mean, I think that's maybe the one expression which passed through my head. It does certainly seem that way. What's going on in your opinion, and where are we at? The bounce has not been that sharp on the up. So we got to about 23,800 or so, which was the low, 27th of January. And then the market bounced a little bit. It was expected, broadly the view was it'll maybe stretch a little bit more, but we reversed much faster. Where are we at and where does it leave us?
Yeah, surely the quick reversal to the downside has probably been a surprise because you've been at the end of a 4-month-long decline. So let us split this view into two parts. One is the medium to longer term and one is the short term setup. Medium to longer term, I think since October, I've been anticipating what could end up being a year-long grind, which we may eventually end up calling a bear market. But it's essentially that you don't make new highs. You have many bear market rallies, you have sell-offs and so on and so forth. So that is like in the big picture. In the near term, however, nothing happens one-sided. So if you had a pretty long fall over several months, you do anticipate that some kind of a counter trend move would happen. And that is the setup with which we were working, I think, from the week prior to the budget. And you're right that we didn't get past 23,800. And once again, we are back to testing the lows. My sense is that we are getting very oversold today, especially when we look at, certain indicators, like we have our daily swing indicator, which essentially tells us the percentage of, a group of F&O stocks which are showing negative momentum, and that's down to around 3%. So when you have only 3% of stocks showing positive momentum, 97% negative, that's usually a point from where markets will rebound. That doesn't mean today itself, but being very, very close to that point today, tomorrow, and you start recovering again. And what I would then anticipate is that we manage to protect the lows of late January, which is 22,800, or even better if we protect 23,006, or which is around 78.6% retracement of the bounce that we had seen. Then we should make one more attempt to go towards 24,000. So that is the first thing I would think about. Can we really make that attempt? Because nothing has really happened in the global markets to cause this kind of sell-off, and we need to also come out of some medium-term oversold conditions. Like a lot of us have talked about the positioning, which is the FIs being extremely short, the client data being extremely long, and they are at the opposite ends of the spectrum. And whenever that has been the case in the past, we have seen markets turn around for some time. And that has not happened yet. We haven't seen any significant short covering. Now, we can argue whether this is directional and the market keeps falling. Definitely, markets are supreme and it's possible. But based on data and based on historical patterns, we wouldn't anticipate that right away. I would expect that markets try to bounce back, loosen up the negative sentiment much more before you get another meaningful sell-off. However, the hard part would be to say the same thing about mid caps relative to large caps. I think that is where the next debate shifts then. But these are the nifty levels with which we'll be working, and still looking for that it does not significantly sell off yet. You might attempt another recovery into March.
Rohit, hi, afternoon. So that's the near-term outlook, right? That we've possibly made a bottom today, tomorrow. There will be a little bit of a bounce back, maybe another meaningful correction. But what about the trend in the market for the next 6 months, 9 months, or 2025? Are we in for, much lower levels? Broadly, directionally, are we headed down? If you look at it from just a larger time frame, and talk to us on what's happening on the mid and the small cap stocks.
So when we take a slightly longer time frame, we've, historically, when we would go into a market correction consolidation, we are used to the idea that, Nifty, mid caps all generally move in tandem. But 2018 to 2020 was a very, different period, which, changed the way the market behaved. And it did so also in an environment where we did have a lot of mutual fund flows starting. That was the starting point of your mutual fund SAHI campaigns. And so all that money kept the large caps elevated even when the mid caps were falling. So that is the main thing to remember. 2018 to 19, 20 till COVID happened, The Nifty was still holding up, coming back to 12,000 after each sell-off, but the broad market was still in decline. I think that is the first thing that we can at least anticipate, that there may be further weakness in mid and small caps. After each bounce, they may still keep selling harder as we are seeing today. But somewhere the large caps may find support, because money in the end has to go somewhere. A lot of money is flowing into funds. They will only reallocate. They will decide, okay, let's not buy too much of mid cap. Let's buy this. They're hybrid funds that will shift back and forth. And so at some level, you end up getting buying coming back to the large caps. And so that may be more supportive of Nifty, Bank Nifty, relative to mid and small caps. So that is the first scenario we should keep in mind. What happened between 18 and 20 can repeat. The alternate would be to have something like 2015 or 2012, where for a 12-month period, both Nifty and mid caps made lower lows and lower highs, and you gave up around 20-30% over a 1-year period. That is the second scenario. But I think given the similarities and more recency, the first scenario has a greater likelihood of playing out. But we will see as it progresses. It clearly highlights one thing, that be careful of mid and small caps. I think that much is clear.
Absolutely. Rohit, hi, good afternoon. I was actually doing homework for the other show that I also host, the personal finance show. And since the pain in the mutual fund part is also really showing up, people are asking, it's all very fine to say long-term India story, but the thing is people still pick up their, funds and look at the NAVs, and they're down quite sharply. Maybe I'll put up this data for, everyone's reference. The mid-cap category, mid-cap funds is the category, in the last 3 months is down about 8%. The small-cap category is down 10.5%. That's 3 months. And not just this, the 3-month correction has been so savage, it's cut out the whole year gain as well, down to about 7% gain average in small cap funds, which is, people will really, sit up and ask questions. Is the risk worth it if my 1-year return is coming down to 7-8% now? Of course, these are absolute returns. They're not rolling returns. So we have to take that in perspective. But Rohit, the question is, what is to be done here? I think, and that's something that people are grappling with. Now, whether you're owning mid and small caps directly or via funds, would you say that this is the time to book whatever profit you have, or do you think that this is the time to just sit tight in at least some sectors and companies? What's the advice? What should be done with anyone's mid and small cap holdings? Anyone who's watching this absolute carnage play out?
So what has to be done is that every time you get a bounce, like we got one in December also, where the small cap index almost made it back to the highs. This time around, it was much smaller. Every time we get these 2-3 week rallies, you need to reduce your weightage towards mid and small caps in favor of large caps. Now, this is usually not true for individual investors who have only, say 10 stocks or so, and they've selectively bought something which they have a 5 to 10 year time horizon for growth. Then it becomes a different game. But when you're really investing only in funds and you're watching 6-month, 1-year performances, it makes a lot of difference if you have over allocated to a particular segment, which most people are saying is still relatively overvalued. So reducing that weightage in favor of large caps or particular other sectors that can do well in the interim might be one way to deal with the problem, because otherwise you'll keep seeing poor performance or even negative performance stretch further on a 6 or 12-month basis, because this segment might continue to weaken in this time period. So that is the thing to keep in mind. And second is also consider alternate asset classes. Very few people talk about. One of the places that have done well has been gold, and gold as an alternate allocation apart from equity is also something that a lot of investors should consider during such times.
Hi Rohit. Rohit, I wanted to ask you about the Nifty Bank. That in fact has taken a sharp downtick. It's at around 49,300. One would have thought a sector where there is valuations which are pretty okay. You have RBI action as well that's taken place, and bulk of the estimates, going ahead as well, they don't appear very, unbelievable, or they appear that they've taken into account yields will fall a little bit. But that one, in fact, is at a very, very crucial level. Where is that one headed?
Yeah, so like you said, it's a crucial level. If we look at all the major indices, it's one of the ones that is losing the least. The Bank Nifty, it's down less than the Nifty. It's not broken the 20-day average, which is currently at 49,272. So it's actually doing relatively better. Of course, it's down because the market is down, and so everything is down. But on a relative basis, if I look at the performance from the 5th of December when the market peaked, The top sectors that we actually see I see on the screen right now is private banks. That is one that comes right on top, followed by IT, banking, and metals. So these might be the areas. So when you see on a decline like this, that these are the areas where we are seeing relative outperformance. That is sort of where I would expect things to remain better when even the markets rebound. So they would be places where I would look at allocating money at this point of time from a maybe at least a 1 month perspective.
Okay. So again, the view, Rohit, is large caps see a bounce from here, maybe the Nifty, right?
Yeah.
Mid and small caps can't say. You're saying institutional behavior could move towards large caps, and that may cost mid and small caps, right? Because you got to, you basically mark to market to the benchmark, and then you can't. It's tough there. Individual, of course, portfolios. That's an important point. The differentiation, and sectorally, anything looking interesting or poised for further declines.
Further decline. So one of the surprisingly most weak segments is FMCG. I think we all thought, including myself, that post the budget it would hold up a little longer, maybe go further than that. But it's broken that entire shelf. The FMCG index, the Nifty FMCG was holding 55,000. It held it around 3 times between late November and mid of January. And after attempting a breakout on the upside, it failed. And now it's making new lows. It's broken the entire range. So that looks like a very, very weak segment right now, despite whatever we may have tried to do. And it means that that's going to keep making lower highs and lower lows. So even when it does bounce, I doubt it will possibly go back to even where it was, pre-budget or around the budget. So that's one of the weakest areas I can see.
My question was weak or strong? Anything looking interesting also from a buying perspective?
On the strong side, I would actually think metal space, even though I know the tariffs that have come overnight are on steel and aluminium. But when you actually look at commodity prices, they are rising. The copper prices have been going up for the last 6 to 7 days consecutively. Aluminium prices are close to a breakout point. So they could very well follow copper on the way up if they go past around, say, 2690. That would be a good breakout point above which aluminium would get strong. Even there are other commodities, things like coffee, which nobody's looking at, which are making all-time highs. So basically what I'm saying here is that commodity prices, and sometimes this is how cycles work. It's bonds, equities, commodities. Bonds tend to peak out first, equities next, and then commodities are last. And so money does get reallocated from equities to commodities in a last blow-off, and which is why sometimes inflation risks remain elevated till later in the cycle. And we are seeing now some kind of a pickup in commodity prices. So commodity-related stocks could be another area which could be positively surprised.
Rohit, thank you very much for that. Just a word on gold. There are two, game-changing events that everyone's watching out for. One, is there a possibility that the US Treasury will revalue its gold assets? So it's currently valued at $42 per ounce, but the current market rate of gold is about $2,900 an ounce. And increasingly, there is speculation that the US Treasury will revalue it at the current market price, which basically reinforces confidence in gold as an asset. And secondly, China has allowed a pilot program which allows insurers to invest in gold. So it takes money away from the US dollars and it will put them in gold. And that again could drive gold prices. So that's just a quick update on gold. But let's move